Hey everyone, Couch Investor back to another video for today. So as promised, this is the second part of a two-part series of the overview of Palantir's quarter. Now, if you missed the first one, it's going to be in the top right corner. That one basically went over the major numbers in that earnings report. In this one, I want to talk on the current state of the company, a couple of things that were mentioned during the earnings call, and some missing links, let's say, or maybe connected the dots. If you went on Twitter and Reddit, some people made some assumptions. Of course, this is only speculations right now, but it might make sense. At the end of this video, I want to touch on the graph as well, because as I said in the first part, $10 will probably be resistance, and then we might make our way back down because there is also a huge gap there. So stay tuned for all of that. So first up, the current state of the company. Right now, we're just over $20 billion in market cap. As you can see, before the market opens, the stock is down 2.6%. Now, overall, if you look at revenue, of course, it is trending up, but as we've seen, growth has slowed down, right? We went from, we project over 20-25% growth or so, to now 17%. But with a company like Palantir, we might see a huge jump in growth over time, just like that. If you look at AWS, for example, in the first, 5-6 years or so, growth was not that high. But afterwards, since they accumulated more and more customers, since the value creation became bigger and bigger, suddenly you saw a huge jump there every single year. Same thing might happen with Palantir. I'm not saying it will. Same thing might happen with Palantir. Now that said, if you look at free cash flow, it has been positive for a couple of quarters now. Of course, I would like to see this increase more and more as we become more profitable as a business. In turn, you can see here return on equity has been positive for 2 quarters or so. Pretty nice, still very low, 2.81%, but it's much better than where we were before in the negative territory. As for gross profit margin, I'm not going to touch on that much, still same overall. But if you look at price to sales ratio, although the stock is down a lot from its all-time highs, as you can see back then, all-time highs, over 45 times sales in the next 12 months made absolutely no sense. But even if at its lowest point, when it was at 6 times next 12 months sales, 6 times is still high. Right now we're at 8.7 times, so not on the cheap end. But of course, things will change very fast if we see accelerated growth in sales. Now, if you want to see accelerated growth in sales, you obviously have to, sell the product more and more. Now, there are 2 camps for this argument. One, the product will sell itself, and 2, yes, we need a better sales team. I'm right in the middle, maybe leaning a bit towards the yes, we need a better sales team, because although the product might be exceptional, people need to hear about it, right? Of course, you see the demos, you see already a couple of customers that prove that the product is working. But again, we follow the company. For this product to be out there and be sold to, let's say, millions of customers over time, you need a very good sales team. Now I'm going to touch on the part of sales, especially when it comes to the AI product, in just a bit. But if you enjoy this type of videos, would really appreciate it if you hit that thumbs up button, subscribe if you have not. We're trying to reach 30,000 subscribers by the end of the year. We're well on track to do that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So let's jump into the earnings call and touch on some key points. So of course, they had to touch on AI and LLMs. So they say the pace of innovation around AI and LLMs presents a unique opportunity for leveraging our Apollo and FedStart infrastructure. There is a tremendous demand for these modules in FedRAMP, Impact Level 5, and Impact Level 6. Via our FedStart offering, we can bring these startups to US government's market in weeks. Now, where did we hear about Impact Level 4 and 5 and 6 previously? Well, in April, Palantir and Microsoft expanded their cloud partnership to public sectors, so they achieved FedRAMP authorization and accreditation to support workloads at US Department of Defense Impact Level 4 and Department of Defense Impact Level 5 on Microsoft Azure. Doesn't stop there, they're aiming to support Impact Level 6 through multi-cloud service integration. I'm going to talk about another cloud player-ish in just a second. With the successful completion of FedRAMP and Impact Level 4 and 5 accreditation on Microsoft Azure Commercial and Azure Government, Palantir and Microsoft are prepared to bring best-in-breed solutions to the federal government. Of course, this will in turn boost both businesses. And I'll end by reading this. With Palantir's Federal Cloud Service FedRAMP authorization on Microsoft Azure, defense organizations have even more solutions available to meet their critical missions need. Our focus continues to be on building up our partner ecosystem to accelerate innovation and provide trusted, flexible, and advanced cloud solutions for the national security missions. Again, this is not a monopoly. This is not just Palantir winning the overall market in this case. Keep that in mind. Now, they also mentioned this. So in Q1, we also closed our first $1 million deal for Apollo with a major tech company. Now, of course, this is just speculation right now. If you've been on Twitter already, this is purely speculation because we don't know who that client is. But if we go back to January, we've had this announcement that Palantir made a strategic partnership with Cloudflare focused on cloud cost optimization. Now, of course, we don't know if this is truly Cloudflare, but if it is, well, that's a big W. And then last two things when it comes to AI. So they said here, our strategy on AI is just to take the whole market. We have no pricing strategy. We're going to create a lot of value. We're going to get hundreds of customers and we will price it as we go. One of the things we've seen over and over again is when you're ahead of the market, you need to take territory. We want to take territory for two reasons. Now, by the way, a lot of people say that this is just not really responsible. Let me tell you this, I'm pretty sure they know how to price their products, but they're just saying this in a way that they're going to show a demo before anyone pays, before anyone knows the price. They're going to show what the product can do. And then if, of course, the product is exceptional, the client will usually say, okay, where can I sign? And then boom, this is what it's going to cost you. And that's about it. I'm pretty sure they have a pricing strategy. And if not, well, yes, that might be an issue. But what are the two reasons? Actually, it's not two reasons, it's three reasons. So one, we believe we have the only product currently on the market that can solve some of these intricate technical needs. Two, we've spent years building certain things like how do you manage knowledge systems across algorithms, across security interest. We know how hard it is to build this. We believe that people will take years for people to build these things. And three, because as we take territory, educate the market, and the market, quite frankly, many analysts believe this stuff is really easy, you educate the market to see how hard it is. And in doing that, you then have pricing parity, basically what I explained before, because they will try other things that for technical reasons are likely to fail. Now, of course, this is great to hear and all, but there needs to be execution. It's one thing to say we have the best product, we want to take the whole market. It's another to actually do it. And we will see if that is the case in the coming quarters. Now, with regards to Palantir, of course, we all know the excuse. Palantir is already 20 years old. How come they are only at the stage they are today? Well, Palantir might be 20 years old, but the products that they're offering are pretty young, or at least younger than 20 years old. If you want, I'll put up a picture on the screen and you can see what happened in the last 10 years. Now, moving up to the balance sheet, and there are a couple of things that we actually didn't go over in the first part. So first of all, they are really enjoying the health of the business and the current state of the environment because as you can see here, they increased their market securities by quite a lot this quarter and this year. So that means that they also increased their total assets and in the same time, they decreased account payables by around 90%, which means if you look at the ratio, total liabilities, total assets, usually a healthy one is 2-to-1. In this case, it's more 4-to-1, which makes it extremely healthy. And you can even see this right here, investing activities, so purchase of marketable securities, huge purchase compared to 1 year ago. And we can continue with the health of the business with the stock-based compensation. Has been coming down year over year, has been coming down quarter over quarter as well. Net cash provided by operating activities, so the core business is now generating more cash than 1 year ago, exactly what you want to see. And we've also got a nice little graph here by Emir, so the employee efficiency crown still belongs to Palantir among peers. This is despite the fact that a portion of the employee force is working with DefenseU for free. And to those that are saying, oh, it doesn't really matter that much, well, revenue per employee for SaaS companies, among other things, is pretty important because, well, as always, it's about doing more with less. If you want to generate more profit, more cash flow, if you can do more with less, then you're doing the right thing. And now last thing here is the graph. As you can see, like clockwork, earnings, huge green candle, bam, we reached $10, we got rejected there. Now this is on the weekly chart. If we go on the daily chart, you can see it pretty clearly, right? Huge gap here when the earnings were announced. Then we reached that $10 mark, got rejected there, and now we're probably going to make our way back down. Now, would we make our way back down back to $7 or so? I don't know, I don't have a crystal ball. First up, we have the 200-day moving average. That might be some kind of support, remains to be seen, but we have here a big gap from $8 or so up until close to $9. So stay tuned for that. Right now, yes, we are going to open at around $9.20. Remains to be seen what happens with the debt ceiling. So of course, lots of uncertainties yet again in this market. But overall, shouldn't really care what happens with the stock. You should care what happens with the business. If the business is doing well and the stock goes down, you're in luck. You can buy more shares for less of a better company. And if the stock goes up and the business goes up, then fine, you have your position, let it ride. Of course, that's just my thoughts. Do share yours down in the comments below. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye bye.